Hello again, everyone, and welcome to Index Options for Income. Now, as a reminder, I am going to change the name of my channel soon. Haven't decided upon a name yet, but look for that change coming up soon. In today's video, I want to talk about yet another option spread that can be very useful whenever you're expecting a large move in the market. In fact, that's the only time you'd really want to put it on. I like to do it in SPX, of course, a broad-based market index, and I want to be anticipating at least an 80 to 100 point move over the next session or two whenever I put this trade on. So let's take a look at this in the Thinkorswim TD Ameritrade Analyze screen. All right. So for this trade, because it is theta sensitive, I'll show you that in a moment. I really like to be out at least 14 to 18 days with the expiration I put this on in. Even though I'm expecting that move, of course, in the next day or two, I want that expiration to be further out so it decays slower. So let's take a look here. A lot of times I'll go around the mid 30s or so in delta. So here we have the 40.75 at 36 delta. And this is just how I roughly start out looking where I'm going to sell my short. So if I want to do the 40.75, do buy back ratio. I know it sounds funny, you'll be buying it, but you will get it put on at a credit. And what I've found best over the years is to do a 2 to 3 ratio, selling 2, buying 3, as you can see here, and 50 points wide. So if you sell the 40.75, I would be buying the 41.25. Now, whenever I do this, I like to get at least an $8 or $10 credit. Sometimes that can really be a struggle, particularly in higher volatility. But as we can see today here in early March, that's a $12 credit. That looks quite good to me. And then I'm going to look at the risk profile. So the idea of this trade is if we move up 80 points, where would we be? Well, we'd be up here. You would simply cash out. Now, with this trade, there is no set P&L. What I recommend is you put this on before the big move happens. You give it that day or two, and when you see that 80 or 100 point move, or at least hopefully you do, take the trade off. So if I put this on today, and then tomorrow morning we opened up here, boom, out of the trade. Or down here, out of the trade. So what you want to do is get out of this as quickly as possible. Because watch what happens here. As I go forward in time, I have it on today's date, but if I go forward in time, right now, if I put this on, let's just say I froze the price right there. If I put it on, you'd be basically break even. But by the time I get even to Monday, look what happens. You're starting to really lose some money. So I don't really want to be there for this, because if it runs up, another factor is you're long Vega. So if we happen to have a rally Monday and volatility went down and the price went up, that's when you get banged up. Not so dangerous on the downside, but on the upside, or even if it stays the same, you'll be losing money. And that's why I like to do this further out in time, at least to slow that time decay a little bit. Now, here we are back to normal. So very simple. Look for something in the mid 30s delta, 14 to 18 days out. Buy your long 50 points higher than that, selling 2, buying 3. And you put this on before a big move, 80 or 100 points. Many times I'll have students come to me on a day when maybe we have a gap opening of 80. They'll go, hey, should we put on a back ratio? Well, not unless you expected to do it again, right? Because the move has happened. Now, sure enough, if we were down 80 and you expected us to move down another or up another 80 or 100, then sure, put it on. But it's not a trade to put on after the move. Generally, you want to get this on before the big move so that you can capture it and take your profits. Just like I said, a little bit about this. It is long Vega. It is kind of an expensive trade. As you can see, the margin on doing 2 by 3 here in SPX is $10,000 less your credit, $1,225. So it would cost us a little over $8,700 to put this trade on in margin. So It's not something that you necessarily, oh, I'm going for 10% of that, like we do in a lot of trades where whatever it costs us out of our account, we want 10% of that. That's not true with the back ratio. We just want to get out of the thing as soon as we can at a profit when it makes that big move. Now, one thing about this trade, unless you stay in it, you're not going to be losing anywhere near that, right? Because if you think about it, if you put this trade on, the market could go to the moon or collapse tomorrow, you would make money. It's whenever you start hanging out in this trade, you know, into next week, look what happens to it. It gets worse and worse. So as long as you get out of this trade in a couple of days, you don't have the concern of losing an exorbitant amount of capital. Can you lose? Of course, I just demonstrated that. But it does, fare much better for you as far as pairing losses if the move doesn't happen, just to take it off in a day or two. But that's the back ratio. It's done me very well at times over the years. Huge in 2020, particularly in the March of 2020, when we had all the pandemic information coming out and the lockdowns, and the SPX was going up and down. It seemed like gap openings for 2 or 3 weeks, up 100, down 100 every day. Trade did terrific in that. Or any other time when you expect some kind of a big event to do this for you in the market, then this is one of my favorite go-to trades for huge movement. I hope you have enjoyed this. Please like and subscribe to this channel. Tell your friends about it. Trying to grow it here. And I will be back next week with another video for you. Next week, I believe I'm going to be talking about trading psychology. So it won't be a trade idea, but the psychology behind trading, how to get yourself set up for the best way of managing a trade. I'll get it out here psychologically, and also what to do whenever you've had some losses. And I'll talk about all of that in the video next week. Have a great day. Bye-bye.